Hello, everybody. My name is Ted Gardner. I'm a senior portfolio manager on Westwood Salient's energy infrastructure team. Today, we're just going to talk about some highlights from June of 2025. It may not seem like it now, but we actually had a 12-day war in the Middle East between June 13th and June 24th. So as you would expect, it was a pretty good month for energy. Oil itself was up 7%, though it was up almost 30% intra-month at its highs, which occurred the day after the US bombed the Iranian nuclear targets. Broader energy equities were up in the 5 to 6% range, and the energy infrastructure indices were up between 2.5% and 3%. We would expect our space to lag a bit in that type of environment because, again, oil has little impact on the profitability in our segment of the value chain, while it much more directly impacts the E&P and service companies. All appears to be calm now, but we did want to spend just a moment talking about what could have happened in a worst case scenario in the Middle East. We've shown this slide a handful of times in the past when we've had other flare-ups in the Middle East, and it highlights the importance of the Strait of Hormuz, which is at its most narrow point, only about 25 miles wide, and it's a key channel into and out of the Persian Gulf. So about 20 million barrels a day of oil, which is effectively 20% of global supply, goes through that strait every day. So as you can imagine, any closure there would have a massive impact on the price of oil and the global economy itself, given a supply shock of that degree. To be clear, we think a closure of the strait was a minimal risk and remains so, but it would have an enormous impact if it were to occur. One of the few reasons that we don't see the strait being closed is that China is a key ally of Iran and actually gets about 15% of its oil directly from Iran, and also gets about 25% of its LNG supply through that strait. So given the political relationship there, we just find it hard to believe that Iran would do such a thing to upset the Chinese and other allies. Speaking more broadly on oil, OPEC continues to bring barrels back online into what we believe is an already oversupplied market. OPEC's overall goal is to bring 2.5 million barrels a day of production back online that it had taken offline in recent years to help support prices. Most recently, they announced a 548,000 barrel a day increase for August, which is above 411,000 that it had announced in previous months. It would take only one more increase of similar size to reach that 2.5 million barrel total. So we would expect that to happen in September. Right now, we have seasonal demand supporting prices. For instance, this is the time of year in which Saudi uses a lot of that oil internally. But all else equal, if we don't get another supply disruption or some kind of demand increase that's beyond expectation, we are concerned that we could see oil move into the 50s and possibly even lower late this year or into 2026. As I mentioned earlier, though, the price of oil has very little direct impact on the profitability of the companies that we invest in. That said, we do prefer natural gas-oriented names in this environment. And while it's still early days on AI, we are beginning to see some of the opportunities materialize for natural gas pipeline companies. This month, we included in our deck some fun facts and rules of thumb, calculations, et cetera, for AI-related gas demand. And just walking through how demand is modeled, what we've observed from the analysts is that they generally have used a 40 to 60% market share assumption for the data centers for natural gas. However, when we look at what's been announced so far, which is just a little shy of 35 gigawatts of projects that are supposed to come online by the end of 2027, it's been an 84% share to natural gas. So if we just look at the average heat rate of converting natural gas into electricity, 7,500 BTU nationwide, that's over 6 billion cubic feet a day of demand already in place through 2027, which is not an insignificant number, given that our base is around 405 billion cubic feet a day. We also know that some of the early natural gas demand will be provided by behind the meter plants, so it could be closer to 6.5 billion cubic feet a day over the next couple of years. Overall, we believe that the natural gas theme is still intact, and we hope to hear about more projects as we move throughout the rest of this year. Thank you for your time today. I hope it was helpful. If you have any further questions, please reach out to your Westwood representative.